Good evening. So, good evening to all. We'll start.
Good
Next
evening,
thing
sir.
is, good evening. Next thing we are going to discuss why this ALM has come into the banking. What is the reason that this asset liability management has become so important or has become a significant role in banking? So what is the reason? I have already told you the reason why this asset and liability has to be managed, because we want to earn more profit. But main reasons for which this thing has come into picture are four. These are the four reasons. First is volatility. Second is product innovation. Third is regulatory environment. And fourth is management requirements. What is this volatility? Volatility, we have all discussed that now when the interest rate regime has been totally deregulated by RBI. Earlier, it was controlled by RBI only. So RBI was deciding what rate of interest. Now, rate of interest has been totally deregulated. So this deregulation of interest rate throughout our country has changed the dynamics of the financial market. The entire financial market's dynamics has changed. Now, a situation is there where we can say that our country is facing, our country has become a free economic country. Or we can say that this free economic environment in the country has affected the money supply. Money supply of country has been affected due to this free economic environment. Overall credit position of the market has changed. Exchange rates has become totally volatile. Price levels has also become volatile. That means what? This is due to the volatility nature of the market, where there is a fluctuation of interest rate every now and then. Not only fluctuation of rate of interest, but also the cost and yield of the asset and liability. The cost of liability and yield on the assets have become also totally volatile. You cannot say that for this period I will be earning this or I will be paying that. Every 15 days or 10 days, your MCLR is changing. Your bank is changing the MCLR. You are changing the deposit rate. So it has become totally volatile. So this volatility nature of the market affecting the net interest income or net interest margin of the banks in a continuous basis. For that reason, to control that, we have to have asset liability management in a continuous basis in the banks. So that is the first reason. Second reason is product innovation. Now we see, after this retail banking concept has been introduced in our country, now you see how many products are launched by the banks. Rapid innovation of the product is happening day after day, because based on the need of the individual customer, either new products are launched by the bank or the old products are renovated or are modified so that they will be suitable to the customers. So whenever such rapid modification or innovations are done, or when a new product is launched by the bank, the ultimate impact on the risk profile of the bank happens. Because every time you launch a new product, what will happen? You are introducing a new kind of risk for yourself. So the impact is on the risk profile of the bank itself. Thereby, what happens? Thereby, again, when risk is introduced, again you have to manage that risk, because due to that risk, again NII will be at a problem. NIM will be reducing. So thereby changing the need of ALM is required. So this product innovation also is I can say it is a factor for introduction of ALM. Without ALM, you cannot just control that risk which you are introducing. Next one is regulatory environment. What is regulatory environment? Regulatory environment is RBI as a regulator is watching each and every step taken by the bank. Because after this Basel Committee recommendation, or the BIS, Bank of International Settlement, has provided the framework for the banks to tackle the credit market and operational risk. So out of these three is credit risk and market risk. Credit and market risks are very, very important, because credit risk pertains to lending, market risk pertains to investment. So due to this risk, due to the fluctuation of the market or fluctuation of rate of interest, this risk of market risk or credit risk may also increase considerably. So this this type of situation has prompted the regulator or RBI all over the world to develop ALM policies, so that all the banks, they should develop ALM policies, they should introduce ALM models in the banks. And last one is management recognition. Now, bank management, every bank's management has realized by now that it is not just good enough to have a good credit product only or a good deposit product only. There is a need to maintain the position to relate and link the asset side with the liability side also. So when you link those products of liability to asset side, that means you have to manage the asset and liability. So top management of each bank has now realized the positive result of ALM. And always they call for the efficient ALM function in the bank. Because the top management has observed that the risk in the financial business has changed the entire game altogether in the banking. So without risk management, without asset liability management, without treasury management, the bank may not survive. So these are the basic four reasons for which ALM has grown very, very significant in the banking sector. Okay, so sometimes a question might be asked, which of the following may not be a reason for significant growth of ALM. So they can give you 5 or 4 things where one of those things will not be there. So you have to remember this: volatility, product innovation, regulatory element, management recognition. These 4 are the main reasons of ALM being significant in any country in the world. Okay. Now, as you know, what is the purpose and objective of this ALM, how it will be done, what provide. Already we have discussed that what is the effective ALM technique should be there. So basically, as I told you, effective ALM technique means, or an effective ALM technique aims at, so the aim of an effective ALM technique is to manage, definitely we are going to manage the asset liability, but what are those things of asset and liability to be managed? So as I told you, first thing is we have to see the volume of asset and liability. Second, as I told you, mix means type of liability as well as tenure of liability. So tenure is, we can call it maturity. Then we have to see the rate of interest part, which is, we can call that how rate sensitive those things are. Due to change in the rate, how sensitive a liability becomes or how sensitive an asset will become. Then fourth is quality of the asset. Quality of the asset, because we don't want NPAs. More NPAs, more losses for the bank. And fifth one is definitely liquidity. So these are the 5 things to be managed, which is the main aim of ALM technique. So if you manage all the things, then definitely you can achieve the targeted return. So basically return is our profit. So every year profit is whatever the profit, what will be the profit, a target is set by the bank management. So to achieve that targeted reward or targeted return or targeted profit, with all the accepted risk in the business, these things has to be managed. So the volume, mix, rate sensitivity, quality and liquidity of all the things to be managed. Okay. So basically how these things are to be done. So this has led to manage those things means what are the significant thing or important things to be done by the ALM department. So first thing is the review. The ALM department should review the interest rate structure. Means what are the interest rate of your liabilities and your assets, whatever you are proposing to pay to the depositor, or what is the rate of interest you are proposing to charge on the loan or charge to the borrower. Because arbitrarily you cannot fix those rates. You are in a market where other banks are also playing. So you have to set a rate which are competitive enough. Because see, now housing loan. Suppose you will say that I will charge all housing loan not less than 8%. Now you go to SBI, you will see that they are charging less than 7%. Maybe 6.75 or 6.5% they are charging. So if they are charging at 6.5 or 6.75 or 6.8%, if you say that I will charge 8%, who will come to you? Which customer will buy the housing loan from you? Nobody will come. So reviewing the interest rate structure in the sense that you try to fix such a rate after comparing the rates within the market which is being fixed by other competitors or other banks for both asset and liability product. So that has to be done. Second, examine the loan and investment portfolio, because you have to always watch this loan portfolio and investment portfolio. The loan portfolio basically as regards rate of interest, fluctuation of rate of interest, and as regard quality. You have to maintain the quality of the assets because we don't want more NPA. Similarly, investment portfolios, where you are investing, whether returns are coming or not. Because again, loan and investment portfolio, again, if you look at the thing, suppose you are giving some foreign currency loans. In such cases, foreign exchange also is a matter of fact, which will lead you to some kind of complication. Because forex risk or foreign exchange risk is there. And investment portfolio in such a loan or investment portfolio, when you are going to sanction some loans, committed to disburse those loans, or you are going to invest something, at that point of time, you have to look at the liquidity aspect of your bank also, whether liquidity is there or not. Whether you can invest as per the SLR requirement, whether investment is full or not, or you want to disburse loans, whether liquidity is there or not. If liquidity is there, then you have to disburse the loan by borrowing from outside. Again, that will be impacting your NII or NIM. Okay. Third thing is examine the credit risk and contingency risk that may originate. So basically, credit risk means default in the loans. So always look for that. Or any type of contingency risk means maybe liquidity is problem. Liquidity is so for that to cover that liquidity, whether some contingency plan is there to avoid that thing. So this again in this credit risk and contingency risk, again there might be some other factors related like a rate of interest which may rise or rate of interest may fall. So due to the rate fluctuation or otherwise the asset quality might be affected. So all the things should be continuously examined by the ALM department. Next is review the actual performance. Means if you have to set a time. So we set a time per quarter, 1 quarter. So 1 quarter, what is the performance of our ALM or entire bank's performance as far as ALM is concerned? So we will see that whether in this quarter what we have targeted, actually we have achieved that performance or not. Means you have to review the actual performance against the projections or target or objective you have made at the beginning of the quarter. And after that thing, you have to analyze the reason where, if at all, we have not achieved that target. Why you have not achieved? So what will be our future strategy to achieve those things? So this is about the review the actual performance. So basically, these are the main things which are done. Now we'll see that the parameters which are taken into consideration for stabilizing the asset liability management. Well, whatever you are doing, when you want to review the performance, what are the things you want to finally look into? What are the parameters? Normally, 3 parameters are being checked to review the performances. They are net interest income, net interest margin, and economic equity ratio. So these are the 3 performance which are the indicators whether your ALM is efficiently implemented or not. So NII, we know what is NII. NII is net interest income. So these are the 3 parameters. Net interest income. Net interest income means interest earned less interest expended. So whatever interest we earn from the borrowing, from the investment or loan, minus interest paid on the deposit as well as borrowed money from outside. So that will be the NII. Second is net interest margin. Net interest margin formula is NII divided by average total earning asset. Okay, so NII divided by, so you have NII here, NII divided by average total earning assets. So basically in the asset side column of balance sheet, you will segregate those assets from which bank is earning. So we have to exclude those assets where the bank is not earning anything. So total of those earning asset has to be taken. So you take the total of earning asset at the beginning of the year, add with total earning asset at the end of the year and divide it by 2. So this becomes your average total earning asset.
Sorry, this one total earning assets, in that NPA and doubtful assets are, we have to exclude or what, sir?
Yeah, whether NPA is an earning asset?
No, that is the reason that is to be excluded.
I told you, only earning assets to be taken care of.
Okay.
Whether cash should be included?
Yeah.
No, sir.
Interest.
No.
No, sir.
Cash is not earning anything. If you are keeping cash, even you keep in the CRR, RBI is not paying any interest. So cash does not earn any interest. Any income, no income is earned from the cash. Maintaining idle cash in hand or whatever is there, this is not earning anything from you. So cash should be excluded. Any fixed assets are there, whether they are earning you something?
No.
No, some fixed asset might be earning. Most of the fixed assets not earning. Some fixed asset might be earning. It's like some go down or some building are there where you have used them, utilize them to receive some rent. If such thing is there, then those assets to be inbuilt. So you have to see which are the asset from where the bank is earning something. So take those balances. So beginning of the year, end of the year, you take, add that, divided by 2. So that becomes your average total earning asset. So when NII is divided by this, then only this percentage will come, and multiplied by 100. So you get a percentage. So NIM you get. So normally NIM percentage is also called the spread of the bank. So this will give an idea. What is the spread? That means higher the spread, more the NIM. Or we can say that higher the spread means bank is earning more. We have discussed in risk management that higher the risk, there is a probability of higher return, as risk is directly proportional to reward. We can interpret this otherwise. If you need higher returns, you have to take higher risks. So we can say that when you aim for greater spread, it will be always coming with higher risk. Without higher risk, higher spread cannot be there for the bank. So we can say greater spreads only imply that enhanced risk exposure. So you are inviting more risk, because unless you enter into the risky business, your reward will not be that much. There might be a higher loss also, but if you do it efficiently, then managing all the risks, then there is a probability that you can get higher spread. Okay, so this is what. And third thing is economic equity ratio. What is economic equity ratio? This is shareholders fund. What is your equity? Equity capital, shareholders fund, divided by total asset. This will be a number, or if you multiply by 100, you can get it as a percentage also. So this economic equity ratio means total assets. Again, this is also total asset means here also we have to take total earning asset, because total asset means all the non-earning assets are coming. So in that way, we cannot get that economic equity ratio. So you have to take the total earning asset also here, so that you will get that what is your capital to total earning asset ratio. This ratio, stronger the ratio, it will say that, or we can say that this will indicate the sustenance capacity of the bank. The more stronger the ratio, more stronger the bank will continue to do the business. So that is called the sustenance capacity of the bank. So these three are the parameters which are normally ALM will look into, that whether this NII is positive, whether NIM is good or healthy, higher, and economic equity ratio is a stronger one or not. Okay, so these are the three things which are in our topic. So I have told you, so sometime question will be asked, so you have to remember the formula of NIM and formula of economic equity ratio. Okay. Now, what are the objective of ALM at different level of banking? So we can say there are two levels. One is macro level, another is micro level. Macro level means it is the top level, top management level. And micro level means it is at the ground level. So what is the job of top management and what are the job of other than top management? So basically, top management job, as we have already discussed in risk management, what is that job? Similarly, in ALM, at macro level, they will formulate all the policy. They will design all critical business policies, etc. All the things will be designed. Just 1 second.
No voice.
Sorry. So top management's job is at macro level means top management what they are going to do. So basically their job is to formulate all the policies. Formulation of policies. Formulation of policies. They will design all the critical business strategies. So business strategy, what will be our business strategy? They will design that. Then they will also look into the fact that how the capital allocation to be made, because risk management is also part of ALM. So allocation of capital has to be done. And also they will look into the fact that how the products to be designed, which type of products will be sold by us. So designing of the products with appropriate pricing. So finally, they will also decide the pricing of these products. Only designing the products is not enough. We have to set the rate of interest also. So at macro level, our top management will do all these things. Whereas at micro level, means at ground level, the objectives of ALM can be divided into two. What at the ground level other people will do. So basically, one is called price matching, second is liquidity. Price matching, why price matching? Because price matching means matching the prices of both the sides, asset and liability, in such a way that our spread will be more. Because our lending rates always should be more than the interest paid to the depositor. Otherwise, there will be an adverse situation. So, price matching means for the purpose of profitability. The main thing is that at the ground level or branch level, the people are accepting deposit and lending also. These are the two functions done by the branches. So that means at branch level or ground level, they have to ensure that how the deposits or liabilities we are getting and how they are being lent at different. Say, suppose your deposit rate is fixed by your head office. Say 1 year deposit rate is 6.5%. Say 6.5% is your 1 year deposit rate. Now, this is maximum deposits are to be, you will find that at say 1 year level, so 6.5% only. Now, there are different types of loans are available, which the person at a branch level may disperse. So which will start from a low rate of loan, say housing loan starts at say 6.75% or 7%. Then other loans say 8%, some might be 10%, some might be 11%, some might be 12%, like that, different types of. So ground level, if the person who is in charge of the branch, he will tell that only housing loan is sellable, I will only do housing loan. That means your margin will be less. Because here 6.5 you are be giving. Now 6.75 is your earning. So only 0.25 is your NII. So this is not profitable. So you have to deploy your asset side disbursement in such a way that you have to deploy some, yes, you have to give housing loan. Nobody denies that, but you have to distribute in such a way that maximum rate of interest, suppose 12% and 13% also, some loans are there. You will try to also lend something in this level. Otherwise, you cannot have more NII. Meaning the accepted deposit rates and the lending rates, the difference between them, we can call that spread or margin, whatever. It should be little wider. The less thinner it is, lesser our NII. Okay, so that is what the price matching or profitability concern is to be done at ground level transfer. You will see that maximum spread or maximum margin has to be there. We are earning, if each branch will look into this margin aspect of our earning, then definitely it will. So basically, the formula is asset rates should be much more greater than liability. So if this is followed by the branches, then a position has to be there for the bank as a whole that the margin or spread will be healthy one. Otherwise, what will happen? Otherwise, there will be a negative gap. Okay. Second thing is liquidity. Liquidity means, again, at ground level or at any other level, we have to always see that as a whole in the bank, there is enough liquidity. That means liability side, always we have to see that we have to canvas as much possible deposits, most preferably CASA. The more deposit we gather from public, we are helping in the liquidity of the bank. So liquidity will be ensured or liquidity will be maintained by canvassing more CASA by the branches. And also you have to see that the maturity profile of the deposits or liability you receive should not be always the less one, because there might be some people who will say, the corporate, they will say that, okay, I will give you say 50 crores of deposit, but I will keep it for only 1 month. So there is no, maybe for 1 month, 50 crore will be okay for you. But as far as liquidity for a long-term condition concerned, we are not having a long-term liquidity. We will have a short-term liquidity crisis not there, but long-term crisis will be there. So the gap for that will be more. So better to canvas deposits which have got a longer tenure period. So this way the ground level people can do that. Okay. Now certain things of asset guidelines which we have not discussed in this management, they are part of this asset life element. So I will just let you know. So we know that there are 3 pillars. We have discussed this one. Pillar 1 is MCR or minimum capital requirement. Pillar 2 is supervisory review process, and pillar 3 is market discipline. Okay, so in this case, we have to remember that according to this, so basically supervisory review process, this capital requirement, we know that what is the capital to be calculated for all 3 risks, market risk, trade risk and operational risk, how it is calculated. Okay, then this supervisory review process, it prescribes a suitable risk management system in the banks and they are reviewed by the regulator. The regulator is going to review that process. And market discipline means you have to have a transparency. So enhance transparency in the bank as regard the disclosure. Okay, so that is the 3 things. So pillar 1, pillar 2, you can say that's pillar 1, pillar 2. If you take into concept pillar 1, pillar 2, There are 17 principles. There are 17 principles prescribed by Basel for Pillar 1, Pillar 2. And in this, Pillar 1 has 13 principles and Pillar 2 has 4 principles. Okay, so 13 principles we are not concerned, these are the different things. So in ALM, basically we should know about what are these 4 principles which are under the supervisory review process. So they are basically principle 1, 2, 3, 4 we can say. So what are these? So principle 1 is that as a supervisor will review the entire risk management process. So first is the bank should assess the overall capital adequacy. So the capital adequacy means your capital adequacy ratio, whether the minimum capital is maintained or not. So assessment of the bank. So bank has to assess the capital adequacy, overall capital adequacy in relation to bank's own risk profile for maintenance of minimum capital. So according to the risk profile of the bank, this capital adequacy structure has to be assessed by the bank. That means what? A stronger bank like State Bank of India or HDFC Bank or ICICI Bank or PNB, bigger banks may have a different risk profile than smaller banks. So according to that risk profile, their capital adequacy ratio should not be limited to 9% only. Because SBI's approach, HDFC Bank's approach, ICICI Bank's approach are different as far as risk profile is concerned. They are aggressive in the market. Their turnover are more. So they need more capital. So according to that, you have to decide what is your adequate capital ratio. SBI may say that as a bigger bank, I can have say 13% or 14% of the capital adequacy ratio. 9% is too less. So this is what principle 1 is. Okay. Principle 2 is supervisor will review.
ব্লু কোড তোর সব নিয়ে যাচ্ছি তো ব্লু আওলাটা এখানে ছাড়িয়ে দে এখানে পড়বি আসবি বইয়ে আনতে হবে না তো
Rupa madam, please sleep madam. You don't attend the class.
Yes, please.
Sir, can I mute everybody?
Yes, sir. Yes, sir.
Okay. Mohanty sir, can I mute everybody?
Please mute all.
Okay. Sir, you just unlock.
Yeah. I done. Principle 2 is supervisor will review this entire thing. They will evaluate this and they will monitor the bank's internal capital adequacy assessment. So that is called internal capital adequacy assessment process, ICAP. That is called ICAP. So supervisor or RBI will review and evaluate as well monitor the bank's internal capital adequacy assessment process or strategies. This is called ICAP, which we have not discussed in the risk management. So RBI will review this ICAP. They will evaluate whether bank is satisfactory in this aspect or not. If they found that this is unsatisfactory, they will initiate appropriate action against the bank. Okay.
We have a duty to pay when presented or when required to do so, but unfortunately the bank manager did not pay it because
Suggest suggest, I think your mic is on. Okay. So this ICAP assessment has to be done by the regulator from time to time, and if they find that the bank is not satisfactory as regard this internal capital assessment process, then they will implement appropriate actions against the bank. And principle 3 says that RBI always as a regulator expects that the bank should maintain the capital adequacy ratio more than the minimum capital requirement. You should not stick to that 9% level which is prescribed. Every bank, as per the business, when business is increasing, turnover increasing, you should always maintain a little bit higher of capital adequacy ratio. That is in principle 3. And principle 4 is, if any bank is failing to maintain the prescribed MCR or minimum capital requirement, immediately a regulator or supervisor will intervene at an early stage in the bank's function to prevent falling of MCR further or below the capital adequacy ratio level. And they will initiate corrective actions for the bank, so that immediately this capital adequacy ratio is brought to a level or this is restored. So these are the 4 principles under supervisory review process. One of the principle 2 is ICAP, which is very important. Other than that, these are the role of the, all here, everything is pertaining to the role of regulator, how they do. Little bit of ICAP, because capital adequacy we know. Capital adequacy should be more than MCR, that is nothing new. And supervisor will always intervene at an early stage whenever the MCR is falling below the level, so that immediately some corrective actions can be taken and the capital adequacy ratio is restored for the bank. So bank has equal responsibility towards each of these 4 principles. Okay, so but the more responsibility lies in the principle 2, because this pertains to the internal capital adequacy assessment procedure. So ICAP, a little bit of ICAP we'll discuss that. So what is this ICAP? So ICAP is, what are the things? Basically ICAP has this role. So basically whatever the risk management is doing, almost similar things this ICAP will be doing. Because this ICAP is under ALM. This is directly under ALM. Okay, so ALM, there is a committee which is called ALCO. So Asset Liability Committee. This is called Asset Liability Committee, where one of your executive director or somebody at the top management will be heading that. So RBI has directed that banks should have that ICAP. Each bank should have this ICAP or internal capital assessment process thing. On a continuous basis, it should be done. So what are the things? This contains, ICAP contains different procedures and measures which relates to identification and measurement of risk, which are done by risk management program. So we know what are the type of risks to identify, then we have to measure that risk. Then maintenance of required capital, that also risk management doing. So side by side they will be also doing. So maintenance of required capital means appropriate level of capital in relation to the bank's risk profile. In the principle 1 we have done. So bigger bank will have to maintain a better MCR or a healthier MCR. Then according to that study, according to the business or the profile of the bank or the strength of the bank or the business which is growing, according to that, bank has to develop suitable risk management system in a continuous basis so that it will be applicable for that growth in the business. Because smaller bank, when it becomes a big, your approach should be also that way, according to your risk profile. Then supervisor to review and evaluate bank's ICAP. That is the second principles to supervisor will review, evaluate bank's ICAP by conducting an independent assessment of the bank's risk profile, and if necessary, they will take appropriate measures or appropriate actions or appropriate supervisory actions if it is needed. They will find that your ICAP process is not satisfactory or it is unsatisfactory. In that case, RBI will come into picture and they will intervene. So this is so basically, what are the things? Basically, what are the structural aspects? Every bank to have an ICAP, which is a board approval process. What are the things they do? They they set the tolerance level of the risk. So how much we can tolerate. So tolerance means we must understand what is tolerance level. So basically, as far as risk management is concerned, a risk can be divided into three categories. As far as this tolerance is concerned, say I can say risk appetite. One can be called risk appetite. Next is risk tolerance, and third is highly risky. So risk appetite, risk tolerance, highly risky. Three things. What is risk appetite? What is risk tolerance? And so basically this is the lowest level, this is the highest level of risk. So risk appetite. Appetite is a word when we see this word means it belongs to our taste. Taste of the mouth. What is my appetite? What is my appetite? How much I can eat? Suppose I am talking about breakfast. Suppose breakfast, I eat breakfast every day before going to office. Suppose I say that normal food, normal breakfast, what I take. Suppose I am taking some South Indian food like idlis. Suppose I take idli in the breakfast. I can say that I can take 3 idlis. 3 idlis enough for me so that it will stay up to 1:30 p.m. where the lunch time will be there. If I take 3 idli, that is fine. If I take 2 idli, it is little bit less. If I take 4 idlis, it will be more. So 3 is the correct amount of idli if I take. So till lunchtime, I will not feel hungry at all. Only at 2 o'clock, I may feel hungry and I can take the lunch. So I can say that 3 idli is my appetite for the breakfast. Okay. But some say I'm not going to office, it's a Sunday or holiday. In that case, at home I am there, some function or something is there. So in that case, I can say that if still the idli is the thing it has meant, I can take around say 6 idli. 6 idli I can consume. That is my final level. Or till 6 idli I can tolerate. If I take 7, it will be totally discomfortable for me. I cannot take 7. 6 is my tolerance level. If it becomes 7 or 8, then definitely it is a high risk level. Means I will be totally uncomfortable. I cannot eat at all. So why I am explaining this? How much is the easiest thing I can digest or I can take? That is my appetite level. Sometimes it might be possible that I can take more. So that will be 6. 6 is the my tolerance level. And more than 6 is high risky for me. I cannot feel comfortable, easy. It will be bringing me discomfort. Same thing is applicable to this tolerance level setting in the bank. What happens? In every bank, branches are there, and branches are again having different branch managers of different scale. So you can have from scale 1 to scale 6 branch managers. Scale 1, scale 2, scale 3, scale 4, like this different branch managers are heading different branches. According to that, the sanctioning power of each level is different. So bank has fixed the sanctioning power. How much scale 1 can sanction, how much scale 2, scale 3, scale 4, scale 5, scale 6 and above. So everybody has been assigned a fixed sanctioning power. Say scale 1 can sanction say 15 lakh only loan. Scale 2 50 lakh. Scale 3 can sanction 1 crore. Scale 4 can sanction say 4 crore. Like this it increases. So these are the risk appetite level of each power, each scale of branch manager head who are empowered to disburse loan. According to that risk appetite, this thing is given. Scale 1 cannot sanction more than 15 lakh. If he wants to sanction some loan, he has to send it to his higher authority. They will sanction and they will approve and they will send. Because it is not within his reach or his power. He is not experienced enough to handle that thing. So that is risk appetite for this. So risk appetite is set by the bank. Similarly, certain things, in certain times, some good customer or good borrowers are there when for a very temporary period, they might be approaching. Suppose a scale 3 branch manager is there whose sanctioning power is say 1 crore rupees. He has sanctioned already 1 crore to a borrower who is a very good borrower for the last 5 or 10 years. He is the best borrower of the bank. He is doing some good business. He certain times comes and tells that I need say 10 lakh rupees immediately for a period of 15 days. Can you give me? So now scale 3 branch managers maximum power is 1 crore. Already 1 crore limit has been given to them. Now he is asking for 10 lakh. It is not within his power. Can he give? If he sends it to higher authority, it will take 3 to 4 days. He says that I need today only. If you can help me, then for the last so many years I'm there. If you don't help me, then I may look for any other bank. I'll go. So in such cases, the tolerance power has been given to each scale. According this tolerance level also given to each scale. So that tolerance power is, it may vary from the bank to bank, which is called, sometimes this is called ad hoc or temporary overdraft limit access can be exercised, or this is called the discretionary power. Discretionary power given to each scale. So normally that is normal case, general case, it may be up to 20% of your sanction limit. So 1 crore limit I have sanctioned as scale 3 manager. So I have a tolerance power of 20%. So 20 lakh I can sanction as a ad hoc or TOD maximum for a period of 30 days only to any of the borrower who is eligible. So that tolerance level is also according to the risk. So this is what the tolerance level is set by the higher authority. Beyond this, anything goes that is highly risky. So they cannot take. So it will be going to the higher authority only. So that's why big loans, say 100 crore, 1000 crores loans are sanctioned. They are sanctioned by the board. Or a big credit committee is there headed by all the GMs and EDs will be there. They will be approving or sanctioning those things. So that is the tolerance level setting of the risk according to risk. Then establish a risk framework. So this is about the risk policy. Policy, how we are going to implement the risk management policy in the bank. So senior management should establish the appropriate risk framework for managing all risk exposures, monitoring this risk align with the bank's capital requirement. And they also look into the fact that we are complying to what regulator is asking for. Then, to monitor the bank's risk exposure, every now and then continuous basis, the risk exposure has to be monitored. Otherwise, we will be at a problem. And we have to monitor at a compliance angle also. Whatever the regulator wants, we have to comply those things. And adopt and support a strong internal control, because internal control is one of the things which will help us to control and prevent future losses. And ensure that written policies and procedures are in place in the bank, which are circulated out the bank, so that each and every person working in these areas, the respective areas, they know the policies, they know the system and procedures. If all the things are taken care of, then we can say that our ICAP is satisfactory. So that regulator will be also fine with these things. And all these processes, whatever is going on, there is a continuous review by the regulator. So board of the bank always sends a report, summary report to RBI from time to time. A quarterly basis it is submitted. So that RBI will take a watch on all these things and they will certify that yes, your ICAP process is doing well. So there is no problem in it. So this is a continuous process. These are the different setting level we will not discuss. So sometimes questions are asked, review of the ICAP by the board. So bank's board will review the internal capital assessment process, capital adequacy assessment process. So at least once a year, the board of directors should assess and document whether the process relating to ICAP is implemented successfully or not. So question asks, how many times in a year the board should assess? So your answer will be at least once in a year, board's ICAP should be assessed by the board of directors. Because ICAP to be an integral part of the management and decision-making culture of the bank. After such assessment, appropriate changes in the ICAP should be incorporated. So review is done for that, whether we have achieved the thing we are taking care of or some changes are to be incorporated in future according to the level of business we are doing, according to the risk profile of the bank increasing, according to that ICAP process has to be also changed. Okay. Now this ICAP, this might be the last slide on ICAP. So this theoretical thing will be ending here. So don't worry about that. This is very theoretical. So you might be totally confused or boring in the time, but you cannot escape from it because sometimes questions are asked. So you have to be careful on this. So this ICAP is guided through a principle called principle of proportionality. Sometimes questions are coming. Question will come, how the implementation of ICAP is guided by the principle called what? So you can say that implementation ICAP is guided through a principle called principle of proportionality. What does that mean? Principle of proportionality means according to the bank's own risk profile, as I told you, business, everything. So according to the nature of business of the bank, individual bank I'm talking. So according to scope of business, according to scale of business, according to degree of complexity of business operation, you have to strategize your ICAP in that regard. Means banks should identify and consider about the nature of business, how big is their business, what is your turnover, what are the risk profile you are having, what is the scope of business next for the next quarter or next half year, whether there is enough growth of the business or not, and if that growth is there, how much it can be growth. That talks of the scale of business. So all the things are to be looked into by individual bank, so that according to that proportionality, the ICAP should be designed and should be done. Means a bigger bank like SBI should have a different ICAP than a smaller bank like a say Federal Bank or any other smaller bank is that their ICAP will be different. Okay, so these are the things which are called the ICAP is guided by principle of proportion. So there is no uniform guideline that this uniform guideline like risk management say that capital adequacy rate is 9%. This is the uniform rate applicable for all. You have to maintain this 9% as the minimum capital requirement. That is uniform. But according to the business growth, everything, again, principles are given. Principle 1, 2, 3, 4 is given that you have to maintain higher than the minimum capital requirement. So that is called principle of proportionality. As per the proportionate increase in the business, your approach towards ICAP should be also in that respect. Okay, so that is what the thing. So assessment of future losses has to be done. Identify and list the area of business facing the most risk. Plan and strategize the management of capital for the next 5 years. These are the basis of principle of proportionality. According to this, you have to design your ICAP. Okay, so this is what the ICAP and the thing we have not discussed in the risk management because it pertains to our asset liability management. Is there any questions? Okay. Now, Rekha has raised her hand. What is the question? Are you asking any question, Rekha? You want to ask any question? Can you say yes or no in the chat box? Rekha, you have raised your hand twice. Is there any question you are going to ask? Can you send a message in the chat box, please? Or it is accidentally you have raised your hand?
I have unmuted them. They can talk.
Okay. So you can unmute and ask me questions.
Sir, you said that ICAP assessment has to be done at least once. Can it be done more than once or only once?
At least once means what?
That minimum once it has to be done and it could be more.
It could be more. At least means minimum is one. At least once in a year. You can do 4 times, no problem. But you cannot leave for 1 year, nothing has been done. At least once board of directors should assess the ICAP.
Oh, okay, sir. Thank you.
What are the kind of questions that will be asked on ICAP?
It's a simple thing. Which principle? How many principles are there? So 4 principles. So principle 1, what is that? Principle 2, you should remember principle 3 and principle 4. So ICAP is under which principle? Which principle ICAP is under?
Principle second.
Principle 2. So principle 2. Then ICAP is guided by what principle? By what principle again? ICAP is guided by which proportionality? Such type of question will be asked. No complex question will be asked. Only fundamental question will be asked about the ICAP. Okay. Sir,
Sir, pillar 1 has 13 principle, pillar 2 4 principle. So pillar 1 or pillar 2 will come from this pillar 1, pillar 2, what are the principle, just like that.
I am covering those parts where from question will come. When I am not talking about 13 things, you should not focus on that. No question has come about that, so that's why I am not touching those things. If you want to read, you can read it.
Sir,
you can read whatever you want to. To enhance your knowledge, you can read those things, but questions are not coming. That's why I am not covering. So only those 4 principles I have covered about SRP or supervisory review process. You should remember that.
Okay, sir. Okay, sir. Good.
Thank you, sir.
Okay. So next is our liquidity management. This is the basic process in ALM. What is this liquidity management? Liquidity is the capacity of bank. Liquidity is the main capacity of bank. So what is this capacity? Liquidity means to fund liquidity. If you have liquidity means you have the fund to increase your assets. Through this fund only you can increase your asset, or these are the fund through which you can use to source your, so these are the sources of your assets. Or you can say that when the liabilities are used or applied, your assets are created. So basically liquidity is the fund which is required to increase your asset. Asset means I am talking about the loan, basically loan or investment also. So if we want to earn more, then definitely fund has to be there. So liquidity is very, very important. Second thing I can say that liquidity will be required to meet both expected and unexpected cash and collateral obligation. So if you have enough liquidity, you can meet expected or unexpected cash and collateral obligations. So what is this cash obligations? Can somebody answer me? What is the cash obligation of the bank? What do you mean by cash? Huh?
Demand liability. CRR.
Cash obligation.
CRR, sir.
CRR. Okay. CRR. CRR is one obligation you have to fulfill. Anything else? Cash obligation.
Daily cash needs.
Liability.
Pardon?
Call money, sir. Call money.
What call money?
Daily cash needs.
Daily cash need for what?
Demand
Why you? Huh?
Loan
customer withdrawals.
Interest payment, sir.
Interest payment. Somebody has to get
SLR.
this.
Demand liability.
loan disbursement.
Okay, loan disbursement. Very good. That is the answer I am asking. So cash is needed to disburse loans. Disburse loan. Any other thing?
Cash payment to customer.
Pay the depositors.
Yeah, payment of deposit. Payment of deposit. So this may be disbursement of loan or payment of deposit can be both expected and unexpected, because payment of deposit, when maturity of the loan is there, when maturity of deposit happening, that is expected. When a depositor comes to premature payment, that is unexpected. So example of expected cash obligation and unexpected cash obligation, you understood or not?
Yes, sir.
Basically,
Yes, sir.
cash obligations means to meet the withdrawals of deposits or fulfilling the commitment of lending. That is called the cash obligation. Okay? So, you have to have liquidity to disburse loan. You have to have liquidity to make payment to your depositors on maturity or premature payment. So those are called cash obligations. Now, what is this collateral obligation? Any idea? What is collateral obligation? For a bank, what is collateral obligation? Obligation means what? Obligation means what? Obligation means?
PO.
Liability.
Okay. Anyway, you understand. So, what is collateral obligation for a bank?
For security.
Security means?
Sir, when
Loan security, sir. Loan
We are getting security.
So, loan security is the obligation of the borrower, not the bank.
In case
Who gives
security value, sir?
Obligation means it is the obligation of borrower to provide security for a loan to the bank. It is not bank's obligation. It is borrower's obligation. Who is giving the security? It is his obligation. Here the question is bank's collateral obligation.
Security for bank guarantee, sir.
FDD sheet.
Indirect liability. Minimize provisions.
LCN BG.
BG, what is a bank guarantee? Bank guarantee is issued by whom? Bank guarantee issued by the bank or not?
Yes. Bank.
So who gives the security?
Customer.
Customer. So where is the obligation of the bank?
Guarantor to the bank.
Customer is giving security.
Customer is giving security, then why you are telling that this is the collateral obligation of the? My question is, I am talking about collateral obligation of the bank, not of the customer. You are not understanding my question.
Sir, less provisioning. Sir, less provisioning.
Government securities, sir.
Sir, suit against bank.
No. FD receipts.
See, you are not applying your logic. Unnecessarily, you are giving total absurd answers. You are not applying the logic.
Yes, sir.
Safety of security, sir. Safety of security. Safety of
security deposit to be given to building owners and all.
Raw materials.
Safety of security.
Insurance.
See, this example, simple example I am giving, you understand, then answer. Otherwise, I will tell you. See, bank is giving a loan. Bank is giving a loan to a borrower. Okay, bank is giving a loan to whom? Borrower. Borrower is giving a security to the collateral security to the bank. So it is borrower's obligation. We can say that giving a security to the bank is the collateral obligation of the borrower. Collateral obligation of borrower. Okay. This is the process here. The obligation is on part of the borrower to give the security to the bank. Here the question is, what is the collateral obligation of a bank?
Gold bond.
Do you understand the question?
Repay the depositors' money. SLR and CR.
To repay the depositors' money.
Government securities, sir.
Reduce risk.
Take the loan from RBI.
So when customer depositing money into bank,
security.
To repay the depositors' money.
Borrowing from open market.
I think I am not able to make you understand this example.
sir. When money
Custody of documents.
Please, one by one.
Safe custody of documents, sir.
Where is the collateral? Where is the collateral? Custody of document. Whose document?
Property, collateral properties.
So, what is the relation of that, say, legal relation between the person who gives the documents to the bank to be kept in safe custody? Is it a creditor-debtor relationship? Safe custody, locker, these are creditor-debtor relationship?
No,
When there is no creditor-debtor relationship, where from collateral comes?
Bank borrowing from other banks, sir. RBI and other. Government securities and
borrowing from other banks against securities.
Government securities and
Yes,
Sir, liabilities.
when I am giving the example,
Currency.
when I am giving the example, you have to relate to this example. Borrower is getting a loan from the bank, so he has collateral obligation. When bank will borrow from somebody, then only collateral obligation will come, right? So if bank borrows under repo or bank borrows from the open market operation, so RBI will ask for collateral. Other bank will ask for collateral. If you do not give collateral, bank will not be allowed to borrow. So in such cases, there is a collateral obligation on the part of bank to provide those collateral. So if you do not have the collateral, you have liquidity, you can buy those collateral, those type of securities which are to be placed under this repo and upper market operation, then you can borrow. This is a simple question I am asking, and you are telling about so many things. Foreign exchange, somebody is told raw material, somebody was selling fixed deposit, somebody was saying payment of deposit. Here already you have discussed. Payment of deposit is a cash obligation. Cash you want to keep. It is not a collateral obligation. Now is it understood? Do you understand what is collateral obligation for the bank?
Yes, sir.
Yes, sir.
It means bank has to provide for collateral while borrowing, or sometimes you have to also place some margin for whenever the borrowing goes up. So at that point of time, liquidity is what you need.
Then what type of security, what type of collateral bank will provide to RBI or other bank for taking for growing purpose? That is,
So-
what type?
So treasury management has classes have been happened.
Yes, sir.
So then, why you are asking me this question? Also, I have also discussed in risk management
Yes,
what type of. I have also discussed this matter in risk management. What are the securities which are applicable while borrowing under repo and OMO? I have told you that two types of security which are qualifiable SLR, they are the part of the security which are provided as collateral when you borrow from repo and OMO. Again, you are asking the same question here. Do you remember 5 type of security? I have told you 1, 2, 3, 4, 5 type of securities there are, which are called approved securities.
Old government securities, treasury bills.
So government security, G6, treasury bills, these are the two securities which are used as collateral to borrow from RBI or any other firm. Other than that, nothing is available as collateral security.
Yes, sir.
I have already discussed. Again, you are asking such questions. If you forget, then it is very pathetic. In the examination, how can you remember? I don't understand. So, first thing is this, as I told you, fund is required to increase your asset. Fund is required to meet expected and unexpected cash and collateral obligation. And third thing is that liquidity, if it is not there, you have to borrow from the market. And if you want to borrow, you cannot arbitrarily borrow, because you want to borrow at a reasonable cost. Because if it is not reasonable cost, again your profit will be going down. So you have to borrow at a reasonable cost. If it is highly costly, then unnecessary borrowing is not a good proposition. It will be a loss. So basically, to manage this liquidity, or we can call that to control this liquidity risk, liquidity has to be managed. Because if there is no liquidity in the bank, then it will be a problem. Because we can say, I think you know the word solvent. What do you understand by solvent? What is the meaning of solvent?
Able to pay the debt within the stipulated time.
Okay, solvent means enough fund is there, or enough capital is there, enough thing is there who can pay his liability within a limited time or reasonable time. So normally, what we see in somebody that we can say that he is solvent. What is the financial indicator?
When the assets are more than the liabilities of a person or an entity, then it is solvent. Net worth is higher.
Assets are more than liabilities. Okay? Is that correct?
Yes, sir.
The deposits are more than loan. Can say like that.
Liability is more than asset.
Liquid asset.
No, asset is more than liability.
Sure.
Asset is more than liability.
Sure.
Type of asset is more than the type of liability. Suppose a current asset is sufficient to meet the current liability, but
Very good. So you have to look into current asset. Current asset has to be there. Now that is the liquidity part. If current asset is less, your fixed assets are more. Fixed asset has a depreciation. So equation of asset is more than liability is not correct. Okay. So basically we see what does meant by solvent. Solvency of any individual or any firm and organization is seen that whether the net worth of that concern is positive or not. So what is net worth? What is net worth?
Equity capital.
Current asset plus current liability.
Net worth is current asset minus current liability.
Capital and reserve.
Paid up capital.
Capital and reserve.
Capital plus reserve is called net worth.
Surplus.
So how I'm really surprised how you have passed JIB. These persons who are telling that current asset minus current liability is a net worth. I'm not asked about NWC, net working capital, or working capital. I have not asked. This is net worth. So capital plus reserve. So basically, when net worth is positive, we can say that it is solvent, because after liquidating all the current asset or whatever thing, still your capital is available. So you are solvent. So we can say that a bank can have four type of situation. Bank can be both solvent and liquid. It's a situation, understand. Bank can be solvent and liquid. Bank can be liquid but not solvent. Third position is bank can be solvent but not liquid. Fourth position is neither solvent nor liquid. So out of this four position, which is the good position?
first one, solvent and liquid.
First one, solvent.
So only solvent is not enough. Means third position, solvent but not liquid. This is not. So other three are weak positions. So only solvency is not the requirement. So bank has to be solvent as well as liquid, because I have told you the conditions why liquidity is required. Because the inability to meet any obligations, cash or collateral obligation, means you have liquidity risk. So basically that will affect the bank's financial condition. So liquidity risk management has to be done, because the variability of loan demands and variability of a deposit determines bank's liquidity needs. Loan demands, more disbursement is required to be made, so you need fund. Variability of deposits, whether deposits are maturing or pre-maturing, or you are canvassing more deposit coming or not coming, is withdrawn. So all this determines the liquidity position of the bank. Entire thing will tell you the liquidity. Liquidity management is the ability of the bank to ensure that its liabilities are met as they become due. Whenever the liabilities are due, you have enough money to make the payments. Or whenever assets are committed or loans are committed to be disbursed, you have money to disburse those things. So liquidity management is the ability to accommodate the decrease in the liability and increase in the asset. So liquidity is required to make payment to the depositors, or give disbursement to the loans. Or other things also, liability, decreasing the liability. So basically decreasing the liability means whenever deposits are going, increasing the assets means loans to be disbursed. So at that point of time, if the bank is able to find enough liquidity, then we can say that bank do not have liquidity problem. So you have to see that how to manage the liquidity, whether there are sources where you can ask the depositor to bring deposits, or if it is not there, then you have to borrow from the market, but that borrowing should be done at a reasonable cost. So that part of thing is called liquidity management. You have to manage the liquidity to maintain that liquidity, because liquidity management doesn't mean that you have to have always idle thing in your bank. Because the more deposits are there, suppose 100 rupees deposit you have received, and suppose 78 rupees you have to lend, but you have lent only say 50 rupees. That means 28 rupees is you have not used. That is also not profitable. You cannot just have liquidity without earning anything. You have to use everything. So that means continuous basis, you have to have the arrangement to get the liquidity for the bank through deposits or through borrowing at a lower cost. Okay. So if liquidity needs are not met, bank may be forced to acquire additional liability under adverse market conditions. That is more rate of interest on the borrowing. So that will be a costly affair. So bank's liquidity management is the process of generating funds to meet contractual or relationship obligation at a reasonable cost at all times. So you have to manage that thing. So that management is to be done by ALM department, so that entire thing are in place. So you are focusing on increasing your NII or protecting your NII only. Okay, so how to manage liquidity problems? So basically, you have to dispose liquid assets. As liquid assets are more, you can dispose that and you have more fund with you. You can increase short-term borrowings at a lesser cost. Maybe overnight borrowing, call money or notice money up to 14 days you can borrow at a very lesser cost. Or increasing the deposit of long-term nature. Say you can canvas for 3-year deposit or 5-year deposit. So deposits are kept for a period of 3 years or 5 years. So basically that will also solve your liquidity problem. These three of the simple example I have given. So many things are there. So sometimes some question will be asked how to manage this. So these are the process given 1, 2, 3, 4, which may not be the one which will solve your liquidity problem. So you can see what are the choices given and which is not applicable. Okay.
Sir, disposing of liquid assets, would you elaborate it, sir? Actually, I did not get it, sir.
You did not get?
Disposing of liquid assets.
What is a liquid asset?
Sir, liquid asset deposits.
Deposit is an asset, huh?
Asset which can be converted into cash within the 90 days.
See, I have at the beginning of this balance sheet management, I have told the asset side starts with the most liquid fund, ends with the most illiquid fund. Cash. So after cash, what was there?
Bank balance.
Bank balance. After that? Investment. After that?
Advances.
Loans and advances. After that?
Fixed assets.
After that? Other assets.
Other assets.
So which are the liquid assets? These two are liquid assets? Yes or no? Whoever asked this question, disposing of liquid asset. So bank balance you are maintaining, that means you are withdrawing that balance, means whether you are disposing that liquid assets or not.
So the third point is increasing deposit of long-term nature can manage the liquidity problem. So if we converse the increasing deposit of long-term nature, it can be used for long-term asset only. So how it can reduce the liquidity problem, sir?
Suppose you are having a liquid, say, liability for a period of 3 years, means up to, suppose you have canvassed 1,000 crore for 3 years period. So you have liquidity for 3 years or not? You don't have to worry for 1,000 crore for 3 years period. Yes or no?
Yes, sir.
So you have the increase your deposit for long-term nature means you have satisfied your or you have compensated your liquidity crisis for a period of 3 years of amount 1,000 crores. So 1,000 crores, if you are given this loan, so you should not be bothered about 3 years period. Liquidity problem for 3 years is gone, over. Yes or no? Suppose you are canvassing deposit of, somebody is canvassing deposit for 6 months only and somebody is canvassing deposits for 2 years and 3 years. Whose liquidity position is more?
It's 6 months one.
Whose liquidity position is better?
Long time.
2 years, 3
long
years.
So this position is better. Somebody said this position is better. How this was after 6 months, immediately you have liquidity problem. After 6 months, they will take the money. You have a liquidity problem or not? So whether this is better or this is better?
2 years, 3 years.
3 years is better, sir.
So the longer the deposit term, the more it is better for liquidity. Okay. So do not think that your liquidity means you have cash in your pocket or not. So that is not the question. Question is whether the fund is available for how many years. As I told you that if an liability of 1 year is invested in an asset of 1 year, the maximum return is, maximum yield is expected. This is the ideal situation. So a 3-year deposit you have that, and if a 3-year loan is given, then maximum return is there available. So you think about this liquidity. Liquidity doesn't mean that tomorrow you have money. Liquidity means you have that much of money for a period of 3 years. Long-term nature. So you don't have to bother for 1,000 crore for 3 years period. You don't have to look for 1,000 crore. 3 years liquidity problem for 1,000 crore is solved for you.
Got it.
Okay. So liquidity management, just this will be last slide we'll discuss today. How this managed. So basically we have to find the mismatch of asset and liability. Okay, so basically we'll see that mismatch of asset liability in this cash flow mismatch. That is what is the we are talking about cash flow means inflow and outflow. So here we are discussing about the liquidity or fund. We are not discussing about the income. Always remember, we are not discussing about the income. Only we are discussing about the fund, liquidity of the fund. Okay, so we have to take care of inflow and outflow. And you have to see whether these are matching or mismatching. So what are the inflow fund and what is the outflow fund?
Inflow.
Deposits are inflow.
Deposit inflow.
And
Advances is out.
Borrowing.
Borrowing.
And
Loan repayment.
very good. Repayment of the loan, repayment of loan. These are the inflow. The outflow, loan disbursement.
Loan disbursement.
Second,
Investment.
Investment.
Third,
Repayment of loan.
repayment of loan is a inflow. Deposit payment. Deposit payment. So these are the outflow. Okay. So now we'll see that outflow and inflow. We'll see if the outflow is more than inflow, then is it a match or mismatch? Whenever outflow is more than inflow. So this is a mismatch. So basically, whenever we are talking about fund, outflow is more than inflow is a mismatch. This is not a good condition. This is a adverse condition. Adverse condition means we have a liquidity crisis or liquidity risk is there. Clear?
Yes.
So when there is a asset liability mismatch, it results in cash flow mismatch. And when the excess cash flow is there, then the inflow, then we have a liquidity problem, liquidity risk. So basically, such mismatch when it happens, they are called the liquidity gap. Whenever the outflow is more than inflow, that gap, negative gap, that is, so the outflow inflow can be positive or negative. So whenever inflow is more than outflow, the gap is positive. Whenever outflow is more than inflow, the gap is negative. So that gap is called liquidity gap. You understand that because in the further chapter, this thing will come, structural liquidity gap, a numerical question will come, you have to understand that. So we are talking here about the fund only. We are not talking about the income. So positive gap, negative gap, how? If positive gap means inflow is more than outflow, positive gap. Negative gap is outflow greater than inflow, negative gap. So here this negative gap is a mismatch. So mismatch we have to see according to volume as well as maturity also. So basically for that each asset and liabilities, everything, so each asset and liability are put into a specific time band. Different time bands are there. That time band is called maturity ladder. RBI has prescribed a maturity ladder where different time horizons or time bands are given to monitor the liquidity graph. So maturity ladder contains 10 time bands. 10 time bands are they're called 10 time buckets. 10 time buckets has been given by RBI. So you have to place all the liability and assets into all these 10 time bands and find out what is the gap of each time band, whether they are positive or negative. If there is a positive means there is no liquidity problem. If there is a negative, then that is a problem. We have to address that problem. Okay, so this is called maturity gap. You just see this gap, maturity ladder, or we can say it is the maturity bands. So first one is the tomorrow, or this is 1 day. Next is 2 to 7 days. Next is 8 to 14 days. Then 15 to 28, 29 to 3 months, 3 to 6 months, 6 to 1 year, 1 year to 3 years, 3 to 5 years, and over 5 years. So all the assets and liabilities, whatever asset and liabilities are there, you have to place your liability and asset according to the remaining maturity of those liabilities and assets. You have to place in each bucket. Then you will see what is the gap. So here liability is 100, asset is 150. So gap is positive or negative here? What is the gap here? Positive or negative?
Positive.
Positive. Suppose this is 100 and this is 80. Then the gap is negative. Suppose this is 80, this is 80. Either this is positive or negative?
Neutral, sir.
Neutral.
No, there is nothing called neutral. Zero is also positive. Okay, just remember this. There is no neutral. If it is zero, that is taken as positive. If it is minus, then it is negative. Unless it is zero, minus, everything is positive. Zero and above is positive. So always remember, positive, zero is also positive. Other than that, there is negative. So you have to see which time band you have a liability, is a liquidity problem. So you can see that suppose 3 to 6 months you have a positive gap tilt. So everything is, suppose this is also positive, everything is positive. Up to this there is a positive. 6 to 1 year you have a negative. Then this is also positive. This is also positive. And this is a negative. So that means what? Every day we are working on this maturity bucket or maturity ladder to see what is the position. This today I have seen that everything is fine. Liquidity problem is there where only 3 to 6 months I have a problem here and I have a problem in 3 to 5 years. So 3 to 5 years is far away. So I am not worried about 3 to 5. Now 3 to 6 months liquidity problem, how I am going to solve that problem? From today I have to prepare myself to fund this 3 to 6. This is how the liquidity management is done by the bank each and every day. Fine?
Yes, sir.
Yes,
Any
sir.
question you ask? Otherwise, from next class, all these numerical things will come. Today was a totally theoretical class. You might have felt bored or something, but I can't help it. It is within the course. So you have to remember that. So tomorrow again we'll discuss about those things which are little bit more complicated or more say mathematical and other things will come. So any question you can ask. No question?
If 3 months to 6 months, if it is negative, and sometimes if it is like 29 days to 3 months, if it is positive, whether we can match with that, since that is maturity of that particular asset is before that 3 months to 6 months period, that can be considered as a little where consolidated decision can be taken in that way.
What decision you want to take? Tell me. You are telling that 29 days to 3 months positive, but 3 to 6 months is negative, right?
Negative. Positive by 20 crores and negative by 20 crores, for example.
Okay. Okay. So first one is positive. 29 days to 3 months is positive. 3 to 6 months is negative.
Negative.
So what you will do? What you want to do?
So liquidity position can be justified like that because when the assets maturity is better than the that 3 to 6 months. I mean, even though there's a shortage in 3 to 6 months, here we have higher liquidity that can be mitigated with the lower liquidity.
No, you are telling plus is here, minus is here, right? Up to 3 months, you have a positive liquidity gap, and over 3 months to 6 months, you have a negative liquidity gap. Is it that you are telling, na?
Yes, sir. Yes, sir.
Then what is your question? See, this 20 crore positive is ending by the end of 3 months. So at the beginning of 3 months, you have a negative gap. So how you are going to solve this problem? Can you are thinking that this will be adjusted with this? How you are going to adjust? This 20 crore will go. This whatever the deposits are there, they are maturing at the end of this thing, so they will take away. Only solving the problem is, can you canvass the depositor to renew this deposit? If they renew, then your next crisis is over.
Correct.
You are getting correct, na?
Yes, sir.
So, if we can canvass these depositors who are going to take the fund at the end of this month to renew further for another 3 months or 6 months period, then this will become a positive again. Na? So that liquidity problem is solved. So that is what ALM department's job is there. If that is not possible, you have to borrow 20 crore from the market to close this gap.
Okay.
You have to borrow from that. Anywhere you have to fund it. You have to fund it. That negative means you need fund on this.
So maybe looking at this position only, the ALM is fixing interest rates for different buckets. Am I right, sir?
RBI is told to fix this. Yes, this is the requirement. Every time, every day, ALM is doing this thing only.
Yeah.
and you have to report. See, this is done by ALM, and every 15 days you have to submit a report on this maturity bucket, which is called structural liquidity statement to RBI. Every bank, 15 days, this statement is sent to RBI. So RBI also monitoring how you are managing your liquidity risk. You should not fall into liquidity crisis. RBI is monitoring. So every 15 days, your ALM department is sending a structural liquidity statement to RBI. How you are RBI is looking at how you are managing your liquidity, because liquidity crisis is the most worst crisis in the banking system.
Okay.
Any other question?
No, sir.
Anything else? Ask me. Otherwise, good night.
Good night, sir. Good night.
Thank you.
Good night, sir. Good night.
Sir.
Good night.